Thanks everyone for coming back to our next edition of Econ Talks. Gareth, we saw the Q4 2020 GDP result come out yesterday, a minus 1.0% quarterly decline. That's seasonally adjusted, of course, taking the annual decline down to 2.9%. A little bit softer, certainly softer than forecasts. We were hoping things had edged up a touch. The other forecasters were ranging around a little bit to a slight down to a slight up. I mean, this was weaker than expected, wasn't it?
Yeah, it was, and one of the key drivers of that result was the fact that imports were quite a lot stronger in the December quarter. What was interesting is that we already knew prior to that imports had been constrained. You look at the bounce back in September, and exports had roared back out of the blocks after lockdown, but imports had a more stuttering kind of pickup. And so the fact that imports were stronger this quarter was not really too much of a surprise. It's just that it was hard to get a good indication of that ahead of time. And so coming through in the numbers, it did make the overall GDP result look weaker. Interesting to note also when you look at the numbers that imports still sitting about 6 to 7% below what we'd think would be normal levels, whereas exports are running up on where they were a year ago. So it suggests that even in the next 2 or 3 quarters, as those import volumes presumably pick up and return to something like normal, that there's still room for some softness. They could drag down some of those future quarter GDP results as well. But having said all of that, while the imports were weak and the headline GDP number was weak, or the imports pulled that number down rather, domestic spending activity and domestic economic activity was actually pleasingly strong. You look at household spending in particular, and that was up 1% over the quarter, which was better than I think we were anticipating ahead of time.
Yeah, and it's interesting. I mean, and I think just important to unpack that sort of import story. Of course, we've got a higher dollar at the moment, which is going to be helping on that import front a touch more. But I think as well important to recognise, that's also a resumption, like you say, of people getting stuff into the country. And so because we're sending that money, across the sea, quite literally, in some respects, that's a reduction on economic activity. Like you say, though, exports still rolling through, but that softness persisting. Now, it's interesting you noted that there's sort of better spending profile, because I think it's better than expected, but it's still not necessarily humming in a sense, and that sort of speaks a little bit to what we're seeing with the current economic activity when we look at some of the industry level profiles in GDP. Construction, for example, quite a decline in a sense, but coming off a very strong surge in September. So you had June where people couldn't be building, September they got going, and there was a fair bit of catch up that went on. December just softening back a little bit from that sort of peak. So it's not that construction isn't doing well, it's just that it's come back off that near-term peak. If we look at some of the other sectors, the likes of transport getting a fair bit better, wasn't as restricted, still awful in a sense, still quite a way down, but regaining some of that momentum slowly but surely. And then the likes of accommodation and food services overall not in the best position, but by the sounds of it, some of that spending, particularly that strength in domestic, is going to be driving a better underlying period. We know we've lost the international stuff, but domestic's apparently still doing relatively well by the sounds of it.
Yeah, it was interesting. We were getting data through from MB on spending activity through the December quarter, and progressively looking weaker after about Labor Day. November and December results were actually a bit on the disappointing side, and had led us to be a bit worried about how households were going, whether that sort of spike and catch up in spending that occurred after lockdown was running out of steam. Well, as it turns out, according to the GDP data out, it looks like households have mostly just switched their spending away from the sort of hardware and homewares and those typical retail areas which had been very strong post lockdown, and a lot more spending actually coming through in some of the services areas. You mentioned travel, and yes, it's still well below normal, of course, but it has picked back up. It is recovering. What was interesting was domestic spending around restaurants, hotels, and accommodation did look very strong. Arts and recreation across the board as well. Spending on those type of services and events really picking up. So people not able to travel overseas, generally speaking, and making the most of those opportunities at home. But overall, that spending picture was still pretty strong from a household point of view. Businesses as well, in terms of their investment spending, a little bit of softness there. I think still contracting down on where it was a year ago, but only around about 3%. And that's not a bad number when you look at at the global financial crisis, we were getting contractions in the order of 25%. So generally speaking, business confidence a little bit soft, a little bit of caution there, but it's not a cataclysmic result by any stretch of the imagination. One of the other points probably just to pick up on over the last few days has been talk around the possible trans-Tasman bubble coming in place over the next month or so. That will potentially lead to a few more Kiwis heading across the Tasman for holidays, and so we may see that just taking a little bit of strength out of some of those services areas. But I think in net terms, New Zealand likely to be a winner because there's a whole lot more Australians than there are Kiwis, and so the potential for Australians to come here and start to boost our tourism sector in those industries that have been very heavily squeezed, obviously, by the border closures is looking pretty positive. I would note one area of caution, though, is just around what the cost of that travel might be for people. That's coming from a guy who's, particularly tight around airfares and never paid more than $150 to get across the Tasman on a plane. It's currently looking at about $650, $700. So it is quite a bit more expensive than we'd be used to. So I think that will be something of constraint on just how quickly we can expect those sort of visitor numbers to pick up.
Yeah, and so because of that, people will be travelling still around New Zealand as well. It's not that it's completely going to kill the domestic roadie sort of vibe anytime soon. But I think also, Gareth, and what you sort of see in the numbers is that there's still that volatility, right, around growth. It's still a topsy-turvy year in a sense. We're not expecting that things will plunge away again, but we're also not expecting that growth just, magically reappears and we're just gunning it moving forward. There are going to be some ups and downs this year. In a sense, the numbers out, the GDP Q4, probably make it relatively likely that we get a technical recession coming through again. March expecting to be relatively soft. We had pretty bad spending activity already. This January to March period is when we generally have those international tourists that would be spending and aren't. We've also had what has been about a week and a half or so at alert level 3 in Auckland, and those restrictions as well, just dampening activity. You sort of hope in a sense that coming through the middle of the year things start to pick up a bit more pace, but again, sort of quite volatile, quite jumpy as we sort of emerge ahead. And I think that's something that we will be keeping in mind, is just trying to understand how the different sectors are moving, how households and businesses are spending or not, and what that means also for the regional economies, and that sort of profile into the future will be quite important. So we'll continue to monitor this, and I'll chat to you about the next result, I'm sure, in about 3 months' time on one of our future editions of Econ Talks.